Welcome to Counters. In this lesson, we're going to be looking at company statement of financial position or the balance sheet. In one of our previous videos, we looked at how to do the balance sheet from the post-adjustment trial balance. We looked at a simple balance sheet. So if you'd like to check that one out, you can click on the link on the top right of the screen or in the description below. But in this video, we are specifically going to look at the statement of financial position for a company. So here we are given information and we are asked to do the statement of financial position as of 28 February 2010. So I've already drawn up the format of the statement of financial position, and we just need to do what is required from the information here and plug in the amounts. So let's look at number one. We are told that the authorized share capital comprises of 1 million ordinary shares at 2 rand per value each. And by 28 February 2009, that is at the end of the previous financial year, 600 ordinary shares had been issued at par value. And during the current financial year, a further 200,000 shares were issued at a premium of 70 cents each. So a few things to note here. There's a difference between authorized share capital and issued share capital. Authorized share capital are the shares which have been authorized by the company. It's the maximum amount of shares that can be issued by a company. And issued share capital is the amount of capital, or the amount of shares that has already been issued. In other words, it's already held by shareholders. So that is the difference between the authorized and the issued share capital. Another thing to note here is the premium. The premium, if a share is issued at a premium, that means it's issued at an amount over and above the par value. So if they tell us that the premium is 70 cents each, we are told that it was issued, that means it was issued at 2 rand plus 70 cents each. So it was issued at 2 rand 70 cents each. And when we record our share capital or ordinary share capital, we record them at par value, and the share premium will be recorded separately. So whenever we record our share capital, even though some of it were issued at the premium, we'll record them at par value, and then we'll record the share premium. So let's see, how do we record this? It told us that by 28 February 2009, 600 ordinary shares had been issued at par value. So that's 600,000 shares times 2 rand each. And we're told that during the current financial year, a further 200,000 shares were issued at the premium of 70 cents each. So to record the ordinary shares, it's 200,000 rand, 200,000 shares times 2 rand each. So to get the ordinary shares, we take 600,000 shares times 2 rand plus 200,000 shares times 2 rand. It gives us a total of 1,600,000 rand. And that goes under equity because that's our ordinary share capital. So we put ordinary share capital under equity, 1,600,000 rand. And then let's record the share premium now. We're told that the 200,000 shares which were issued during the current period were issued at a premium of 70 cents each. So we're going to take 200,000 shares times 70 cents. It gives us a total of 140,000 rand. So we record that under equity as well because it's our share premium, 140,000 rand. Let's move on to number 2. We're told that the following balances appeared in the books on 28 February 2010. That is at the end of this period at which we are doing the statement of financial position. So we are given land and buildings at cost at 1.8 million rand. So we know that land and building is a non-current asset, so we record it under non-current asset section. So we record land and building 1.8 million rand. We're also told that equipment at cost 300,000 rand. So we record equipment under non-current assets because it's a non-current asset. So we record it at cost 300,000 rand. Then the next one, creditors control 720,000 rand. Creditors control is a current liability, so we record it under that section. So creditors control 720,000 rand. Debtors control 530,000 rand. That is a current asset. We record it under current assets. Creditors for salaries 36,000 rand. For the salaries that we are yet to pay. So we are going to put it under current liabilities because that's a current liability. And then income receivable. So that's income that we are yet to receive. So that is a current asset. We'll put it under current asset. Then cash at bank. You know that cash is a current asset as well. So we record it under current assets. So we've just recorded all of them that have been mentioned in number 2. Let's move on to number 3. We are told that one of the fixed deposits, 175,000 rand, matures on 30 September 2010. The rest matures in 2012. We know that fixed deposits is usually a non-current asset, but then we are told that one of them matures at 30 September 2010. Now remember, we are doing the statement of financial position as at 28 February 2010. So if you're going to receive the fixed deposit within the next 12 months, and yes, it is within the next 12 months because it will be received in September 2010, that means it's a current fixed deposit. It's a current portion of the fixed deposits. So we have to put it under current assets. And they told us that the rest matures in 2012. So if we had that amount, we put it under non-current assets because it's going to be received after 12 months. So we put current fixed deposits 175,000 rand. Let's move on to number 4. We are told that a loan of 1.5 million rand from Easy Bank was originally received on 1 March 2008. This loan is to be repaid in equal monthly installments over 5 years. It's very important to pay attention to the details here. So if we look at that, we know that the loan is going to be repaid over 5 years, as we have been told. Now we want to know how much is repaid annually. So we're going to take 1.5 million rand, divide by 5 years. It gives us 300,000 rand, and that is the amount that will be repaid each year, 300,000 rand. Now I want to find out how much has already been repaid. If it was issued or it was received in 1 March 2008, that means from 1 March 2008 to 28 February 2009, 300,000 rand has already been issued, has already been repaid. And from 1 March 2009 to 28 February 2010, it means another 300,000 rand has already been issued. So that means for February 2009, for the year ended February 2009 and February 2010, 600,000 rand has already been repaid. So what is the balance of the loan? The balance is 1.5 million rand minus the 600,000 rand that has been repaid as at the end of this financial period. It gives us a total of 900,000 rand. That's how much still needs to be repaid, 900,000 rand. Now how much will be paid in the next financial year? That means within the next financial period, it's another 300,000 rand. So we're going to put that under current liabilities, 300,000 rand. That is the short-term portion of loan, 300,000 rand. And then we take 900,000 rand, which still needs to be repaid, minus the 300,000 rand, which will be repaid within the next 12 months. We get 600,000 rand, which will be paid after 12 months. So that will go under our non-current liabilities section. So put loan from Easy Bank, 600,000 rand. That's how you handle that one. Let's move on to number 5. All the equipment was purchased on the same day, 1st October 2007. Depreciation is written off at 20% per annum on cost price. So by 20% per annum on cost price, they're talking about straight line method of depreciation. We do not know what that is. You'd like to understand more? Click on the link on the top right of the screen or in the description below. But the dates are very important when we are calculating depreciation. So what we are trying to calculate here is accumulated depreciation, because accumulated depreciation affects our non-current assets, in this case equipment, and it's a contra asset account, so it will subtract from our equipment. It will be subtracted from our equipment. So the equipment was purchased on the same day, 1st October 2007. Bear in mind, we're doing a statement of financial position as at 28 February 2010. So let's count from 1st October 2007 to 28 February 2008. That is how long the equipment was in the premises of the company until the end of the first financial year since it was bought. So it was 1st October to end of October. So it's October, November, December, January, and February. So those are 5 months. So we're going to take the equipment, which is 300,000 rand, times 20%, times 5 months, divided by 12 months, because we had it for 5 months for the year ended 28 February 2008. So that gives us a total of 25,000 rand. And then to the year end 28 February 2009, so we had it for the full 12 months, so it's 300,000 times 20%, which gives us 60,000 rand. And then from 1 March 2009 to 28 February 2010, which is this current financial year at which we are doing the balance sheet for. It's 300,000 times 20% gives us 60,000 rand again. So we add them all together. Remember, accumulated depreciation is all the depreciation related to a specific asset, that is equipment. So we take 60,000 plus 60,000 plus 25,000. It gives us a total of 145,000 rand. So we'll put it under equipment as accumulated depreciation on equipment, and then we put 145,000 rand in brackets. So we've just completed number 5. Now let's read number 6. The following financial indicators apply at the end of the financial year. The net asset value is 2.58, 2 rand 58 cent, and the price on the JSE is 3 rand 10 cents. The current ratio is 1.5 is to 1. So you may ask, why did they give us those details? Why does it matter? So you can see here that our statement of financial position obviously always has to balance. Total assets always has to equal total equity and liabilities. If it does not, then we have done something wrong somewhere. So now, what is net asset value that we are given here? Net asset value is equal to total assets minus total liabilities. So that is the net asset value. What else do we know about net asset value? Net asset value is the equity of the business, is the capital of the business, or the value of the business. And if you know how we get equity, total assets minus total liabilities equals equity, because we know assets equals equity plus liability. So assets minus liabilities equals equity. So the net asset value will give us the value of the equity, the total value of equity. So that is the net asset value, or the big value of the company. Here they gave us the Johannesburg Stock Exchange price, how much is trading at, and this is the market value. But we're not concerned with the market value, we're concerned with the net asset value. So how do we get the total value of the company? We take the total number of shares issued, remember, not authorized. Total number of shares issued, which was 600,000 plus 200,000, and multiply that by the net asset value, which is 2 rand 58 cent. So 800,000, that's the number of shares issued, times 2 rand 58 cents, that is the net asset value, equals 2,064,000 rand. What does that mean? That means that is the total equity of the business. So we can take this 2,064,000 rand and put it here as the total equity. So we're just going to take the 2,064,000 rand and put it as total equity there, because that is the value of the equity. So we have that amount there. So also you must bear in mind that if you take total assets minus total liabilities, total equity, and total assets minus total liabilities, it should give us equity, this amount here. Now let's see equity here. We have ordinary share capital of 1,600,000 rand. We have share premium of 140,000 rand. If we add the two together, it gives us 1,740,000 rand. So it does not equal 2,064,000 rand. Why does it not equal that? That means we are missing something. There's still a value of equity that we still need to put here. And we are done with the information that we were given here. So you would be wondering why they gave us the net asset value. Well, the reason they gave us is for us to figure out what is missing here. If you can think, what else goes into the equity section apart from share capital and share premium in this case, which we have? What else goes there? Well, if you guessed retained earnings, then you are correct, because when we have the net income or the net profit, if we do not issue any dividends or would not use the money for expansion or things like that, then we will put it always goes to retained earnings, and retained earnings is recorded under equity. So the balance will be the retained earnings, the one that is missing to make the total equity 2,064,000 rand. And how do we get that? We take 2,064,000 rand minus 1.6 million rand minus 140,000 rand. It will give us the value of retained earnings. So you can see that retained earnings is just a balancing figure. So we have that amount there. It gives us a total of 324,000 rand. So if you add the three together, 1,600,000 rand plus 140,000 rand plus 324,000 rand, it will give us 2,064,000 rand. That is why they give us the net asset value, to figure out what we are missing from the equity section. A lot of students usually struggle with this part where they're given ratios and net asset value, and they have to figure it out. But if you know what they stand for and what they mean and how to use it, it's very simple. It's fairly simple to do that. Okay, now that we have the total equity, we have no other information apart from this one here, where we are told the current ratio is 1.5 is to 1. But now let's first total up our non-current liabilities and current liabilities. So our non-current liabilities is 600,000 rand. We only have the loan. And then our current liabilities, we add all of them together that we have here. Creditors control, creditors for salaries and short-term portion of loan. And then it gives us 1,056,000 rand. And then we total equity plus all the liabilities, non-current liabilities and current liabilities, gives us 3,720,000 rand. And we know that total assets has to equal that same amount. So now let's go back to this. We are told that the current ratio is 1.5 is to 1. Now if you know the current ratio is current assets divided by current liabilities. If you do not know what the current ratio is, you can click on the link on the top right of the screen or in the description below. But that is what current ratio is. You take current assets divided by current liabilities. Now here you can see that we have all the current liabilities. Now we have to figure out on the current assets. So current assets divided by current liabilities has given us an amount of 1.5. That is what we are given in the information. So that means current assets is higher than the current liabilities, because current assets is 1.5 while current liabilities is 1. So that is how the ratio is always written. Something is to 1. So we know that current assets will be higher than this amount here, 1,056,000 rand. That is how we know that it's the asset section that is missing. How do we know that? If you total all these the current assets, if you total them up, 530,000 rand all the way to 175,000 rand. If you total them up, you will realize that they don't even get to 1,000,000 rand. They don't even get to 800,000 rand. I mean, it's a small figure. Well, it may get to 800,000 rand, but it doesn't get to 1,000,000 rand. And we know that current assets has to be more than current liabilities because of this ratio here. So we know that there's something missing from the current assets. So how do you calculate the current ratio? First of all, current ratio equals current assets divided by current liabilities, and the answer is 1.5 is to 1, which we are given here. So let's reverse calculate to get what the amount for current assets is. It's a simple formula. You just take the current liabilities, or the denominator, which is the current liabilities, you multiply that by the current ratio, which is 1.5, and it gives us 1,584,000 rand. That will be the value of current assets. If you'd like to confirm that, you can just plug in 1,584,000 rand here, and then divide that by the current liabilities of 1,056,000 rand. It will give you 1.5 is to 1. So now that we have the total current assets, let's put that in the total current assets. So that's 1,584,000 rand. Now again, we have the same situation as we did in equity. If you add all this up, it's too low. It does not equal 1,584,000 rand. So what does that mean? There's something missing here on the current assets section. So let's think about it. What could be missing here? I'd like you to take a guess. You can pause and think about it. What else goes into the assets? We know trade and other receivables or debtors control goes there, cash goes there. But what other common thing goes there? Well, if you guessed inventory, you are correct. So that is inventory. We'll put that as inventory, which is missing. How are we going to get the value of inventory? Well, we're going to take the total current assets, which is 1,584,000 rand, and minus all this amount, deduct all these amounts that we have here. It will give us the value of inventory. So we put inventory, and it gives us 789,000 rand. So if you add all this up, it should give you now a total of 1,584,000 rand. Now that we have the current assets, we have total equity and liabilities. Let's go to the non-current assets section. Now we know that total assets equals total equity and liabilities. So from that knowledge, we know that if you take total equity and liabilities, which is 3,720,000 rand, and you deduct the current assets, 1,584,000 rand, it will give us the total non-current assets. So let's do that. We take the total equity and liabilities minus the total current assets. It should give us the total non-current assets. It shouldn't confuse you, because if this is the total non-current assets and plus the total current assets, it gives us total assets. So total assets, these two have to equal total equity and liabilities. So that's how we calculated it. We took the figures that we have to get what we don't have, which is the non-current assets. So that means this 2,136,000 rand is the non-current assets. So let's put in that figure there, 2,136,000 rand. Now let's see what we have in non-current assets. We have 1,800,000 rand, we have 300,000 rand, we have negative 145,000 rand. So what does that gives us? What's the total? 1,800,000 rand plus 300,000 rand. It gives us 2,100,000 rand, and you deduct 145,000 rand. It will give us 1,955,000 rand. So it does not equal 2,136,000 rand. Again, just like current assets and equity, there's something missing. So what do you think it could be missing from the non-current assets? Well, if you look at your information, you should be able to get a clue. So I'd encourage you just pause here and try and figure out what could be missing from the non-current assets. And now we'll see that right now. So what is missing from the non-current assets? If you look at note number 3 or the information number 3, it told us that one of the fixed deposits, 175,000 rand, matures on 30 September 2010. Well, we've taken care of that, but we are also told that the rest matures in 2012. That means we still have other fixed deposits here. We were not given the amount, and that's why we'll figure that's what we'll figure out here. That means that's the missing non-current asset. So you could put here fixed deposit, but we know fixed deposits is an investment. We are investing, so you can put here fixed deposit, but I will put investment. But it does not matter. You would be marked correctly, whichever one you put between the two. So I'll put investments, and how will we get the amount there? We'll take the same procedure we did for current assets and equity. We'll take the total non-current assets, 2,136,000 rand, minus 1,800,000 rand, minus 300,000 rand, and then you can put a plus minus 145,000 rand, or you just put minus 145,000 rand, and then it should give us the balancing figure, which is investments, and it gives us 181,000 rand. Now you can check if it's correct. You can just add them up together and then deduct the accumulated depreciation and then add the investments. It should give us 2,136,000 rand. Now, if we add together the non-current assets, 2,136,000 rand, plus the 1,584,000 rand for the total current assets, it should give us the same amount as total equities and liabilities. So add them up and see, it gives us 3,720,000 rand. You can see total equities and liabilities is equal to total assets. That means we did everything correctly. So that is an example of a statement of financial position relating to a company. So that is how you go about it. So if you've gained any value from this lesson and you've learned something, please consider subscribing to our channel and liking our video and sharing it if you can. And please comment down below at what level you are studying, what level of education you are at. That also helps us in the kind of videos that we create. So you can comment down below and let us know. If you have any questions or any queries relating to this question or any other video of ours, you can comment down below. Till next time, cheers.